We're joined by Deutsche Bank's Chief Economist, Torsten Slok. Torsten, there's a lot of conversations going on here about global growth, but growth sometimes comes with side effects. What are those side effects?
Absolutely. I think that this year's event is really coming to a point where consensus is appreciating that there are three side effects that are very critical, namely pollution and climate change. Then there's also inequality, and then there's higher debt levels. And if you take these three things combined, you say, well, shouldn't we just have as much growth as we can have? Well, maybe we now reached a level of welfare and a level of income, of standards of living, where maybe some of the consequences are just so negative. So that's why a lot of the debate and a lot of the things around these unquantifiable issues of climate change, inequality, and debt levels haven't gone up so much.
Torsten, President Trump, in another interview today, suggested if the Fed just cut rates again, the U.S. economy would be growing close to 4%. Do you agree with that?
So, I mean, if you take the Fed's modeled purpose of the U.S. economy and you ask the question, if you lower the Fed funds rate by 25 basis points, you will only get roughly 0.1, 0.2% more in GDP. So in that sense, even if the Fed went all the way down, it would be difficult to get all the way up to 4. That being said, you could start thinking about today whether the Fed should not have raised rates in 2018 and whether they cut rates too little in 2019.
Do you think they will cut again soon?
So the bottom line to that is it's all about inflation. The economics profession, as you all know too well, has just had a really hard time predicting inflation for so many years, and inflation has been incredibly subdued for a very long time. Even though the unemployment rate is only 3.5%, we see a little bit of wage inflation, but not much, and we definitely see not much in consumer price inflation. So the Fed has been arguing much more around the issue of is there inflation or not. And for now, the answer to your question, Brian, is we just don't see any rise in inflation on the horizon for the next 18 months.
Let's dig into some of these side effects you were just referencing. Inequality. This is something that's come up over and over, and sometimes I watch in your chart books that you put out about things like the stock market, for example, and you'll see President Trump tout the stock market and the gains there. But the reality is not everyone's benefiting from the climb in the stock market. What are some of the myths, if you will, around that?
Yeah, so after the financial crisis, one of the main effects was that the Fed cut interest rates that lifted stock prices, that lifted home prices. Who benefits from that? People who own stocks, people who own homes. But since the financial crisis, there are fewer people who own homes, there are fewer people who own stocks. So that means that the wealth concentration was on fewer hands. So almost by definition, the Fed was part of the reason why we got more inequality. So the answer to your question is that because of inequality has gone up, we also now have had that people at the low end of the income distribution who have a higher propensity to consume, they tend to spend more of their money when they get it. They have unfortunately not been contributing as much to the recovery, and maybe therefore inequality is actually a reason why the expansion has been so weak for the last 10 years.
Could you tie inequality to climate change? Is there a correlation there? Is there something to that?
I think what's interesting about that question is also think about it, both the ECB and the Fed at the moment are having a review of their policies, and the ECB has been particularly outspoken, Lagarde, saying we should actually look at climate change, we should look at inequality, and we would say, well, in financial markets, why should we look at that? But maybe it is because we've gotten to a point where these other things that are going on around GDP per capita, before we just close our eyes and say, oh, that's probably not a problem. But it looks like now that this is becoming more and more an issue, that even the central banks are thinking about changing their missions. At the same time, the Fed and the ECB having a review and changing their potential missions is a potentially very important issue for markets.
Torsten, Christine Lagarde is about to announce the outcome of her strategic review. How disruptive could that review and those findings be to markets?
So that could actually potentially be quite disruptive because think about it, both, as we spoke about earlier, both for the Fed and for the ECB, inflation has been incredibly low, surprisingly low. It's very difficult for economists to explain why inflation has been so low. So maybe now, of both reviews, maybe the outcome is to say we're going to allow overshooting in inflation, we're going to allow inflation to be a little bit higher. And that's another way of saying we're going to keep interest rates lower for longer. And if interest rates are lower for longer, it could be boosting stock markets and corporate bonds, IG, high yield level loans more, simply because if the risk-free rate, in this case the Fed funds rate and the ECB rate stays low, well then people will continue to hunt yield like we've seen and we've discussed for the last 10 years.
Getting back to U.S. markets, do you think U.S. markets, U.S. investors have lost their mind? I'm looking at this IMF report we got this week. Global growth, 3.3%. Something doesn't seem right.
Well,
we have the market trading out at 21 times earnings?
That's right, and as you think about also, that's a relatively, it was a downstep from what their growth projection. I used to work at the IMF in the division, put it together.
Well, they do good work, all right.
They do very well, good work. But at the end of the day, they have been revising forecasts down, which is telling the market, well, maybe the Fed will therefore stay on hold for longer, and therefore we know what that means. If the Fed is dovish or interest rates stay low, I should go and hunt yield out the risk spectrum. First, I should buy investment grade credit, maybe high yield, maybe even equities, maybe even emerging markets, with the whole idea that if the risk-free rate, the Fed, is going down, then I should just hunt yield, even no matter what happens to fundamentals. So you're right to say there looks to be almost central banks versus fundamentals, because fundamentals are not getting too much attention. It really is all about, is there more dovishness or central bank money printing coming around supporting financial markets?
Torsten, before we let you go, a lot of people are learning things here at the World Economic Forum. What have you learned so far?
Well, I am taking away from the program that you have running here just next to you that some of the sessions are like on plastic bottles, it's on rising levels of oceans and other things. And some of these things is a unique opportunity to hear things and think about things that you haven't thought about too much, at least before. So I try to go and see things and try to broaden my mind and say it should not only be about unemployment, inflation and S&P 500. We have to look out broader. And I think this is what the whole forum here does so well, namely try to discuss a broader range of issues than the things that we just talk about on Yahoo Finance, namely what will happen to the dollar, to interest rates and to the stock market.
Torsten Slok, Chief Economist of Deutsche Bank, thank you so much for joining us.
Thanks for having me.